Weekly stock market update. And obviously big events to cover in this. So let's get on with actually some amazing opportunities. I've become incredibly optimistic from an economic stock market point of view. This is not individual financial advice or solicitation to buy any particular stock. If you'd like to download a free copy of my book, alpeshpatel.com/links. Hedge fund managers, Bloomberg TV presenters, Financial Times columnists have all written lovely things about it. So let's go back before we go to the stock market, what all of this week's events mean. First of all, you saw the market rally. That's partly because of certainty of outcome, and that's essential for the market. Also, there's likely to be tax cuts. That's important as well for the market. Liberalization, very pro-business as well. Corporation tax likely to be cut with the view that there'll be some kind of peace dividend out of ending conflicts in the Middle East and in Europe. That should mean lower oil prices, lower cost of living, more people having more money to spend. So the consumer discretionary sector shot up as well. Whilst I say interest rates higher for longer, you'll notice there's been a 0.25% cut. That wasn't based on the outcome of this week. That was based upon economic data up to this point. They haven't made any assumptions about the future. They made that very clear. So I think now that's the last cut we're going to see for, I suspect, a while. Tesla stock, of course, shot up. Why wouldn't it? He's going to be a double trillionaire, and you know who's going to help him. Deregulation, particularly of crypto, such as Dogecoin, that's coming, and we know that's coming. It also boosts animal spirits, that X factor Keynes talked about what makes an economy grow. And animal spirits, you can see it from some of the commentary already on television, that's coming. Now, deregulation generally, meaning oil exploration, coal production to create jobs, what that means for the energy sector, not entirely clear yet. You would think it would mean lots of profits, growth, it should do. And speaking of growth, the US focus is far more on growth than it is in Europe. Europe's focus is on capping inflation because old money, rich money doesn't want to see that wild away, whereas the American, more risk-loving, is let's go for growth. And again, good for the stock market in that regard as well. It will be inflationary. That means asset prices are likely to go up. This is what Schroeder said. Asset prices are likely to increase. That means stock prices are likely to continue increasing. The problem with prices increasing is if earnings don't increase, then sooner or later you end up falling off a cliff. Now that's fine. Riding a bandwagon is perfectly fine. When I was on Bloomberg TV in the early 2000s, I'd often say, look, we're riding a bandwagon. That's perfectly fine as long as our job is to make sure we tell people to jump off it before it falls off the cliff. This is one of the reasons why Dow futures jumped 800 points. The market puts its money where its beliefs are. What is extraordinary, of course, in all of that is that we've gone a year without a 10% correction. That's what a 10% correction would be. We've had 8%. What I would say to you is, so if we get another 6 or 8% correction, do not be panicked. It's due, just statistically due, and it'll be there to freak out people, but it'll be a buy the dip opportunity as things look like it. In any event, we know the S&P 500 in November and December on average is a great period for stocks. That's on average what happens to stocks, okay? One of the reasons, of course, if you're watching this in the UK, that I want your pension, your SIP ISA in US equities, is we are more likely than ever with a left of centre set of policies in the UK to continue having this kind of poor growth. This is from 2009 to 2024, and in the US have those kind of numbers. Okay, that's the NASDAQ, that's the S&P, 300%, 600%. You're left with 47 in the UK in your pension if you're just even tracking the index. That divergence, which has been going on very significantly since the financial crisis in 2008-9, that's going to get even wider. So if you're lagging behind and your pension stuck with some poor wealth manager who can't deliver returns, and especially if you're in any of these terrible funds with a relative performance to their benchmark of those kind of numbers, you're going to be even more in trouble going forward. The stock market won't be able to help you in the UK going forward on these. Not least because we've been told corporation tax in the UK will be 25% for the next 5 years. It was 19. Okay, the Conservatives raised it to 25. It's going to stay like that for 5 years. So that drag, that fiscal drag, when the state believes they can do better things with my money than I can do with it, which is fine, because they want wealth redistribution, means obviously growth is going to get hit. I've got less money in my company to use on investment. It's that simple. Simple math. So I'm going to invest less. The other problem with keeping it all in your SIP and ISA in UK funds or St. James's Place, God forbid, or anything like that is this. They're going to deliver you about 5% returns. It's going to take 14 years to double your pension. Whereas what we're seeing out of the US consistently in sterling terms over the last, 15 odd years is 15% returns. If you can even with performance improve that, then you're going to double your money in between 4 to 5 years. That's a bloody big difference to 14 years. Okay, it's all about returns and riding that wave. In terms of valuations, everything looks expensive still. You're paying $27 for every dollar of forecasted profits in Apple. Those numbers are going to increase in terms of expense. Okay, they're going to increase. We will keep an eye out for any of these greens to see as and when opportunities arise. And we'll do that through our usual approach, value, growth, income. We will score, and this is the most important sort of holy grail part of it for me, the secret sauce, the proprietary algorithm. We'll look at the valuation of companies, and we have specific measures for valuation. We will look at revenue and earnings growth. We will look at dividend yields, and we will weight that twice as much as that and twice as much as that. And we also look at things such as cash flow growth and cash return on capital invested, but in a very specific format, the same format that Goldman Sachs Wealth Management use. We'll look at momentum, Sortino, and alpha. We need all of these 5 boxes ticked green because we know undervalued companies which are growing with high cash flow returns and high average returns with low downside movements that have a trend of performing well tend to continue performing well. Okay? And that's why we want that. And if you've not already seen it, that's alpeshpatel.com/shares. Don't forget to do all of this. More of the stock market coming now. Over the past week since the big event, this is what's happened. Amazon, Tesla, I mean, that's in a week. That's in a week, okay? As I said, with that NVIDIA. JP Morgan, some of the banks which are undervalued are doing well, so that's good news anyway. But you can see a heck of a lot of greens, which is good news. Over the past year, that makes my life really easy. The more greens there are over the past 12 months, the easier my life is. However, when these went up, they had periods where they dropped. Some of these dropped 30%. NVIDIA in that period has dropped 33%. If you don't like individual stock volatility, you've got to ask yourself, yeah, I know we all like the 214% and we don't like the 33%. If you can't handle the 33% because when it happens, you panic, you don't know what's going on, then that's fine. You've got to sacrifice the 214. You can't have both. You can't be bipolar. And there are alternatives for you. You can just go more into exchange-traded funds. Okay? There are alternatives for you. Over the past year, this is how it looks. 36% up on the NASDAQ and the S&P. Of course, there are long periods of moves which move sideways, and here where you've got 0% returns, and here where you've got 0% returns, here where you've got falls, here where you've got falls, here where you've got falls. This is what people don't get. Now, if you don't like those moves, then as Warren Buffett would say, the market's not for you. You can't have your 36%, can't have your cake and not eat those moves, okay? ETFs over the past month, I guess the real standout stuff is this. This is going to get deregulated, so you're going to see more of that stuff happening. And Bitcoin is at all-time highs as well. Okay, I'll do a separate one on funds generally. Now, given what's just happened, I would expect over the next 2 years, we're going to see a 32% return on the S&P. That's what I'm thinking over the next 2 years. Okay, at least. Might be more. Positive returns happen 88.5% of the time. The average positive return is 32%. I'm just playing historic numbers. The past is no guarantee of the future. What I will watch out for, just in case, is be your lighthouse watchman, your guard, to make sure if we stay out of any of these falls, which happen infrequently, so my job is easy. But my job is to look out for that. So I'm very excited about this for my pension, for my SIP, my ISA, my son's junior ISA, my wife's SIP. And I'm excited for those who follow me, like Trevor Atkin, who in the last 12 months I've seen a 30% increase in my portfolio. This is amazing for me and my family. I cannot thank Alpesh enough. Thank you very much. And there's loads of these. They're on alpeshpatelreviews.com. Oh, look, there we are, alpeshpatelreviews.com. And there you can actually see videos and case studies. So do have a look at videos and case studies as well on there. S&P 500, this is where we are. Now, previously I was more worried that this is overbought, it might be here, and we could eventually get what I call a daddy bear, which is when that scenario happens. However, I am less concerned, though I keep watching things. This may well go like this. We don't know yet. I'm certainly less concerned. There's nothing for me to do in terms of my holdings. NASDAQ, similarly, yes, there are some what are called bearish divergences. There are some concerns. This could be a double top, that it could easily fall from, what is that, 400 to 420. Therefore, you knock off the same distance off. You'd be down to about 350, which is exactly here. There is a concern. But we are getting ahead of ourselves if we say 350 is going to happen. Of course, there would be a concern to the downside. There always should be. However, as things stand at the moment, I'm still expecting this, and I'm still expecting those moves. Okay? For those who haven't got SIPs and ISAs and pensions, very easy. You don't have to use Barclays. You can use anybody. It's not an Barclays advert. You go online, you put in your details, you wire some money into the account, and then you buy the stocks that you want. So you might say, I want to buy $1,000 worth of Microsoft, for instance. Okay, there are many brokers. Call them up. Don't look at these numbers, because these are so difficult to compare, and they have caps and so on. So that looks terrifying. And then you call them and you say, well, actually, they've got a cap, they've got this, they do that. I've got accounts with all of these. And I have no issues with any of them. Some are more expensive than others, but because you're holding for 12 months and not constantly going in and out and trading through a SIP or ISA, you shouldn't get hit by the Forex. What really worries me and what people need to get a grip on is this. Has your pensioner lost a fifth of its value this year? This is from the Daily Mail, okay? Workplace pensions, retirement plans, please check them up. They're really screwing you over on these, and I'm worried for you. Give workers power to ditch pension schemes. Value for money choice. Sarah Smart, Chair of Pensions Regulator. The Pensions Regulator reported in the Financial Times, says give workers power to ditch pension schemes. That is how bad those pension schemes have become. So please watch out. Why do those retiring face massive losses despite FTSE highs, says The Guardian. It's not just the right-wing media, it's the left-wing as well. Retired plan was shocked to see his Aviva pension had dropped 20% in a year. Please check it out. That's Aviva. It's reported in mainstream media. You're missing it. You don't know. This is the Telegraph. So we go from left to right. Have British fund managers become pointless expense for investors? Worse fund managers take $500 million fees from investors. So I want people to have control of their pensions. I want them to be more in charge of their investments for that reason. And I cover on videos like this on YouTube. So have a look at alpeshpatel.com/links to look at those. Now, in terms of the individual stocks, I will go into great detail for those on my Great Investments program. If you've not joined, feel free to go to alpeshpatel.com/shares to sign up. But for now, just so you know, I've not had to make any decisions to sell my Apple, my Amazon, my Microsoft. And Microsoft's the only one that I'm really keeping close on, just in case that becomes a daddy bear like it did here, and I should exit. But that's only happening on Microsoft. When that happened before, it was happening with all the stocks and the index. It's not happening at the moment, but it is somewhat of a concern. And if I have to exit, I will exit. Meta, I've not had to take any action yet. And yes, we've had gains, particularly from there all the way there. So in April, when I exited it to rebalance my portfolio, because we had these massive, massive gains, if I still held this, I would continue holding it. I've got the others. Okay. I'm a top voice on LinkedIn, so do follow. Don't connect with me unless you're a client, but otherwise you can just follow on there. Now, 3 things are going to happen, guaranteed, in the next year. And 2 of them are going to cause you to panic, and 1 of them is going to cause you a loss of money. So the 2 you're going to panic at is when the market falls, but you don't need to panic if the momentum's rising. And it falls even deeper, you still don't need to panic even though the momentum is falling. You're going to then ignore this one, which is going to cost you money, but I won't ignore it because that's called the daddy bear. When it's at a high overbought level, falls below its moving average at a steep angle. Okay, we don't have that at the moment, but this is how private investors end up losing money. They ignore this one and they get out too early in these two. Okay, that simple. For us, we may never get a great year like 2021. Again, 54%. Last year, 80%. 2022, 0%. When the markets fell 20%, we just were holding cash because it was the daddy bear. So we just have to hold cash in that. Okay, we might never get this again, but let's make this absolutely clear. That return didn't come from our ingenuity. It came from the ingenuity of all these companies, which were doing well. If the market didn't give a tailwind, we wouldn't have got such a great return. Because undervalued companies, high growth and producing dividend yields do crazy returns like this. Well, why did we only get that, 54, not 208? Well, for the very simple reason that we didn't know that was going to go up 208. If we did, we would only have bought that. So we had some which didn't do as well. But wait a minute, how did you end up with some which didn't do well if your criteria are always the same, value, growth, income, because it's not physics and some do better than others. We're trying to remove the mistakes as much as possible. Our rules, 12 months, 25% drop. I'm going to say from entry because from highest point confuses people. So from entry, okay? So last year might never happen again. But I suspect under Trump we're about to get in the next 2 years. If I get this in the next 2 years, which I think we will, over 2 years, 80, then I'm more than happy. Okay, and how did these come about? They all tick the value growth income box, not by the end of 12 months. And some are in the quality 5 plus anyway, and they had rising momentum and so on, okay, in 2023. But notice the disparity, the variance. Yes, one was down, the other was up 238. If I knew what was going to go up, I would only have bought that, not that. This doesn't include my leverage plays, which, as you will know, my son has leverage 2 times in using ETFs on Apple, Microsoft, Alphabet, Amazon. Meta I got out of his because it was just getting so large that even a small movement, and I needed to rebalance the portfolio. One holding was just causing the whole portfolio to move more than the others. So that's what I mean by rebalancing. Okay, I think we're going to get that again over the next 2 years. I'm not saying over the next year because that's harder to determine, but over the next 2 years because of the statistics I showed you before. So that was exceptional. That wasn't down to me. It's because the market has been exceptional. It's not because don't have the bias of thinking, oh, your process is amazing, that's why that return happened. No, the market was amazing, which is why that return happened. The job of the process was to make sure we didn't have too many of this end of the market, this end of the market, and we had enough of this end of the market, okay? So let me go into a few more details. I know it says Barclays again, but the details, if you want to download a free copy of my book, alpeshpatel.com / links is where you go to download a free copy of that. I've written many, but you can download a free copy of this one from there. And I've written a heck of a lot of others, published by the Financial Times, amongst other publishers, and some of them are international bestsellers, in case you're not aware. This one's heavy. Okay, that is Trading Online, again, published by the Financial Times, an international bestseller for me. And these are thick books, reviewed by and endorsed by the likes of some of the biggest names in investing. So that's who I am. Why do I say Croaky is so critically important for me? Because this research from Goldman Sachs and their quantum database and the Goldman Sachs Global Investment Research Team, they have a research team, R&D, research and development team, whose job it is to deliver returns for their clients. What they discovered over a period of research is 30% per annum is the average return for companies in the top quartile by cash return on capital invested, okay, by Croaky invested. So we want to tick that box. I'm not saying all my portfolios will have 30% per annum because, look, financial crisis, they don't do that. But it certainly made a difference. So I stole that like Robin Hood and gave you the data and information. And the result is we avoid, this is an email from somebody who said, they were with Bruin Dolphin, we avoid all this spray and pray business, or Fisher, and instead they've done a hell of a lot better. and I get loads of those, and I love that I get those. The holy grail for me is, therefore, the spreadsheet. Well, most importantly than the spreadsheet is the Alpesh Value Growth Income Rating, the proprietary algorithm. That is based on the work of Richard Thaler, Daniel Kahneman, and Eugene Famer. Okay, many people try to reverse engineer it. They won't succeed. They'll come unstuck because that is an important factor, the value growth income rating. Okay. It's like 3D printing. If you try and reverse engineer it, it's like, okay, you've created something which looks like the real deal, but it's not. It's a waxwork. Great to have hedge fund managers, Merrill Lynch, and Wealth Management, Coutts Wealth Management endorse BBC. So, as well as real people. You can see their videos on alpeshpatel.com alpeshpatelreviews.com. If you want to join the program, that is where you go, alpeshpatel.com/shares. I will then tutor you for life using Telegram to keep you updated with the markets every day. Skype, Zoom, WhatsApps, whichever you prefer. Thanks to those levels of communication we can now have. Doesn't matter where you are in the world. You can be in Canada, or some of my clients are. You can be in Australia or New Zealand. My job is to I created a hedge fund in 2004. 20 years later, I want to create an asset management company which is very different. Get venture capital investment into it and then float it. It's an asset management company where you manage your money. I don't. You don't pay any fees to the person giving you the data or giving you the information, teaching you and handholding you. So you keep your assets, you learn how to do it, have the handholding and the data and all the hard work done by my team of plumbers, data analysts, and graphics people, so that basically anything that I wouldn't feed to my family, I won't feed to you. So that all the hard work's done for you. That means that we should be able to get rid of a St. James's Place and those wealth managers and IFAs and all the rest of it and level the playing field far more for private investors. Okay, so you don't need to have Goldman Sachs Wealth Management, 50 million in your account to get the croquis for them to select the stocks. You've got the data, you're able to do it. Robinhood empowering the regular person. Okay, if you want to join, there it is. When I do one of these updates, I do knock off a fair bit. That's the URL, alpeshpatel.com/shares. Okay, but that's, and the price is going up, I think, next week. The team will keep me updated. The most important things people want from it are those two things. That's the thing they always say they want. If you'd like a tour of all of this, my colleague Paresh, who was a floor trader on the London International Financial Futures Exchange, he launched a hedge fund, co-launched a hedge fund, has co-authored with me books on investing and trading, which includes all his strategies from that hedge fund in there as well. If you'd like a tour, alpeshpatel.com/links, and he'll give you a tour of the Great Investments Program as well and show you how we do all of this and why it's pretty bloody amazing. Okay, thank you very much, and that's the end of the market update for this week. Don't forget to like and follow for more as well. Thank you.